Man, do I have an opinion on inflation? First of all, let me answer this question right here, right, that everybody wants to know. So here's topic number 3. Ready for this? Are we in a housing bubble? Are we in a housing crisis? Short answer, no. Okay, this isn't 2008. This isn't 2007.
B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
Where mortgages weren't regulated, appraisers weren't regulated, where real estate agents who don't want to take onus for part of the crash, everyone blamed it on the banks, right? But real estate agents, the bad ones, were just as involved in paying off appraisers for overinflated values. So if you don't know, and if you're not familiar, what happened to cause the crash in 2007, 2008, was these overinflated values of these houses that really weren't worth what the appraisers were appraising these houses for. So basically, lenders and real estate could say, hey, I need you to make this house worth X amount of dollars, even though that house is not worth. It's like saying that Target playset is worth $200,000. We all know it's only worth like $100, right? And then the second thing that happened was banks were getting greedy. So this was on the financial industry. We were doing subprime mortgages. So if you don't know what subprime means, they were lending money out to people who had no business qualifying for a mortgage. They had no credit or bad credit. We weren't doing verifications of income. We weren't doing verifications of employment. It was just stated income, stated, employment and whatnot. So that's a recipe. If you're not verifying if I came to you right now and I said, hey, I need to borrow $100, $20, $30, $50, whatever the amount is, and I just met you, and you don't know me from Adam, you really gonna give me that money? Probably not, right? Like, I'm asking you to break out your money that you go to work for every single day just to give me whatever I'm asking you for, right? And you're probably gonna be like, even if you were, you wanna know, can I pay you back? Am I employed, right? So I have the means to eventually pay you back. Am I gonna pay you back when I say I'm gonna pay you back, right? So it's no different, right? When you're trying to borrow $250,000 to buy a house. Like, you're asking this bank for $250,000. Like, it's completely asinine. So fast forward to what the market is doing now. So my 2 cents of what I think the market is going to do. Because we don't have to worry about the subprime mortgages and the market collapsing, I think right now in this current market, there is an inventory issue, right? Nationally, anywhere you go, inventory's tight. It's just simple economics of supply and demand, right? There's more demand than there is supply. And that's what's causing this great appreciation in value of homes. So your rate of appreciation is going higher. Okay, so that means the asset that you actually own in the house is appreciating at a much quicker rate. So right now, to buy a home, if you can do so, is a really smart move. Okay, rates are still historically low, and I know we hear that everywhere you go, but they're still really low. But I think as we go into the end of quarter 3 and into quarter 4, the market's going to level out, and we'll start seeing more inventory come on the market. And I think rates will probably start to even out. Right now we've been kind of seeing, it kind of being volatile because think about it. The government just came up with what, $6 trillion, $9 trillion out of money out of thin air. They just printed money. They just went to the back of the basement and say, yeah, give me another $1 trillion. So what most people don't realize is they're so happy about these stimulus checks. They're so happy about the cancellation of this possible student loan debt. But what you don't realize is somebody has to pay for all that. And it's like a fountain. And eventually that fountain is going to run out. Okay? And if the government is giving you a stimulus, they have that money's coming from somewhere. That's coming from an increase in taxes, whether you don't realize that or not. Have you checked the price of a gallon of gas lately? How about the price of a gallon of milk? Go check the consumer price index right now for the cost of increasing goods over the last couple of months since the government's been printing money. So you're sitting there thinking, oh my God, I got all this stimulus money coming into me. I really could use it. And you very well might need it. You very well might need that stimulus. But think about it. That same $500, just take $500. That same $500 in stimulus money that you got today is actually worth less than 6-7 months ago. Because the rise of inflation, because the Fed is trying to curb, they've increased the Fed funds rate, which is another conversation. Sidebar, if you ever hear the Fed is increasing the Fed funds rate, that's the rate that they charge other banks to borrow money, student loans, credit cards, and stuff like that. When that happens, usually mortgage rates go up. So it's like an inverse operation, just so you guys know that. But so you got this $500 and you're thinking, oh man, I can use it for this and that, or whatever it is. The funny thing is the people who don't need it, that are getting it, are just saving. They're saving that money. The people that actually need it, they're using that money. But again, it's good that money just runs out, right? So now you have money, you got that money, now it's a down payment for a car or whatever it is, or whatever you're gonna use it for. You use that money, you now inject that stimulus money back into the economy. But then what happens, because it's not sustainable? So you take that money, you go to a restaurant, the restaurant does well for a day or two or a month, whatever. You go buy the car, there's inventory for the car. The car salesman gets his commission, the car dealership, gets paid. But what happens is now that stimulus money runs out, you're still not back at work. You can't pay for the car note. Note goes in default. Bank loses money. Then bank starts restricting how much money they're willing to lend out again because there's no more government money to be spent, right? So take that for what it's worth. We're not in a crisis, right? Because we're doing, financial banks in Wall Street and this Consumer Financial Protection Bureau, which is our big brother, right? That government entity back in 2008, created by President Barack Obama, created that so no predatory lending was happening. They're actually putting, qualified individuals into mortgages. But that's where the market is going. And, we're short answer, it's going to level out. Rates will start to remain at a steady level, and I think we'll see more inventory. And I just think we're just touching the tip of the iceberg with this real estate and housing industry. Going into 2022. And I think every year we say that, but do you know why every single year it gets better if you're in this business? Think about the rate of like millennials now and, Generation X and Y, like becoming adults, right? They're not interested in renting because rent increases nationally anywhere between 4 to 6%. And your rent will eventually outpace your earnings and take up all of your money. So that's why housing is so important for it to become affordable. So take that. That's how that cookie crumbles.